It's now been nearly 1 year since the collapse of Silicon Valley Bank and the subsequent banking crisis. Our next guest has co-authored a new paper that offers a primer on how to focus future banking regulations. I want to bring in Columbia Business School Professor Tomasz Piskorski. He's a research associate with the National Bureau of Economic Research. Good morning, and thank you for joining us. We are a year out. I'm curious, do you think anything has actually changed in the past year, Tomasz, before we actually get to some of the suggestions and recommendations and things that you're thinking about need to happen going forward?
Thanks for having me on. So last year, the regulators managed to short-circuit the bank run. But, the fundamental vulnerabilities in the banking sector remain, and they're really rooted in a very high financial leverage of banks. A typical bank in the United States is financed 90% debt, it's mainly deposits, and only 10% of equity, which means that even a small drop of asset value, say because of high interest rates or credit risk like commercial real estate distress, can put these banks potentially in an area when they're subject to solvency runs. So what to do about it? A natural thing is to raise capital requirements. And, if you look on non-bank institutions that are in a similar business than banks, they retain twice as much capital as banks. And in fact, our work shows that one of the reasons why banks are so financially levered is their access to insured deposit funding, especially the smaller and mid-sized banks, which are the banks that are particularly subject to all kinds of risks nowadays. So, a natural... sorry, go ahead.
Well, one of the things that I was going to ask you, though, is there's a big question about, whether we should have higher capital requirements for these banks. And yet when you look at just the sheer number of loans that banks make today relative to the shadow banking system, there's an argument to be made, actually, that they don't make, the banking system in America is not necessarily powering the credit market in America today. And so should we think about it differently?
Yeah, thanks for asking this question. This is an excellent point, and it's actually a subject of our new work. If you look in 1970s, about 60% of all loans to households and firms were held on bank balance sheets. Nowadays, it's only about a third. Two-thirds of lending to firms and households is financed by outside of bank balance sheets. And in fact, what it means if you would raise capital requirements on the banks, even substantially, the impact on overlending would be fairly modest. And it's simply because, the debt securities market, think about mortgage-backed securities, corporate debt market, other type of securities market are much more important. And, the funding really comes from money market funds, pension funds, hedge funds. So the banks are simply not as important in financing lending as they used to be.
So if that is the case, then are we fighting, last year and last decade's war when it comes to higher capital requirements on the banks or not? And should the real focus be on, as people describe, the shadow banking system? Or do you think that the way the credit markets work today, and you look at the Apollos and the Blackstones and everybody who's playing in that game, arguably you could say it's just a very different structure?
You're right, but, these structures are now much more important than they used to be. What we're trying to tell to regulators, and we're engaged with discussions with them about that, is that, we naturally focus on banks because we provide them a guarantee. We provide them the deposit insurance. So as taxpayers, we are at risk here. But, most of the lending activity happens outside of the bank balance sheet, which means, we should focus more attention on that security market and non-bank institutions when we think about the impact of our regulation on lending. And I'm not to say that, there is no problems there necessarily, but the regulators should start shifting their attention there as opposed to just exclusively focusing on banks.